time where we talk business and, to be precise, matters taxes. Today we delve deep into understanding taxation of rental income. One that would probably get you all trying to, just be on alert to get to understand this. In most cases, one would ask, who then is supposed to pay this? Is it the landlord, landlady, or is it the tenant? Those are some of the things that we'll be asking this morning, and we seek to get answers from the specialist on board. As always, we have Edwin on standby so that at least he can take us through this particular process. Indeed, a great conversation are lined up for you, so make sure that you keep it right here as we all get to learn some more. Edwin Thiongo, tax lawyer, good to have you this morning.
Thank you, good to have you too.
Yes, all this courtesy of KCK. So it's business with KCK this morning, and that's what we focus on. Remember, the lines are open. You can always call live. He will be here to respond to you. Hashtag Morning Cafe at Linda_Lela TV47KE. We get to sample some of your comments as we proceed with the broadcast. When we talk taxation on rental income or of rental income, what exactly are we talking about?
So the taxation of rental income is mainly tax levied on anyone who has properties that he's letting out for commercial use and both residential use.
Yeah.
So rental tax is a regime of tax that specifically tries to get revenue from landlords who own both commercial and residential property.
Right.
So broadly speaking, rental tax is classified into two main areas. So you have your commercial rental property, and you have your residential rental property. But all the same, these two properties are taxed differently. To say that if you have residential tax, you usually pay your tax every month. If you have commercial tax, you're supposed to pay your rental tax at the end of the year. And therefore, those two regimes were introduced so that you're able to classify these taxes and to make it easy to collect.
All right, when we talk rates and the individuals that are eligible, just what exactly are we talking about? Because mostly then we think rental and we'd assume, well, the people who've rented the houses, we'd assume, well, the individuals that own the houses now, that is the landlords and landladies, just exactly who is supposed to pay for this?
So for residential tax, which is letting of houses for residential use, they have created a cap that it must, if your rental collection per month is above 288,000,
okay,
all the way to I think it's 15 million. It used to be 10 million.
Yes.
You are supposed to.
It has been expanded to 15.
You're supposed to be paying this tax. So the threshold of paying, the rate of paying the residential tax on a monthly basis, which you'll hear in tax circles, is called MRI. It's called monthly rental income tax.
Yeah.
So the MRI taxes are paid at a rate of 10% of the gross. So they will say that we do not want you to offset any form of deduction.
Yeah.
Instead, just pay 10% of whatever you've collected.
Okay.
But for the other regime, which is the commercial, and anyone who has residential but falls outside this bracket, they're supposed to pay these as a form of income tax. So at the end of the year, just like we calculated the other day on business income, so they'll declare the rental income and subtract that. I think later on maybe Jeff is going to take us through how exactly to do these calculations. Yeah.
All right, when you speak about that, then this evidently is all about the landlord, right? And so it's got nothing to do with the person who's rented a house and everything. It is out of what it is that they pay that the landlord now collects to pay for this, right?
Yes, absolutely.
Okay, so and then one would want to understand, is this final? Is it done on a monthly basis, like you have said, or is it something that you can probably decide? Well, I'll file my tax returns annually, or I'll pay this once and for all annually.
Okay, so for rental tax, a residential rental income tax, if you fall within the bracket, you have no option. You must pay the 10% on a monthly basis.
Okay.
So what the law says is that you can pay it every month, or quarterly, or half yearly.
Okay.
But you must declare it every month. So you remember when you say when we spoke about tax last time, we said you have an obligation to file, and filing is not paying. Filing is simply declaring I have this income. Then you are supposed to pay it within a quarter, a month, or half yearly. So you find a lot of landlords have preferred to just declare and pay, but the law allows you to carry it forward for a month or so, which I think sometimes can be strategic if you have short-term investments you can do before you make the payment.
And so if your property is not occupied, then you can proceed to file zero returns?
Yes, so if your property is not occupied, you must file and say we do not have any rental tax, and therefore, because you've already taken up that obligation. And every time you have an obligation for tax purposes, there is always a responsibility to file. Payment depends on whether you have the income to pay, but for filing you must file. So what they'll do is that they'll file a nil return, meaning the houses are not occupied, but if they were occupied, they would actually file and then pay much later.
Okay. All right. What information is required in this case? Because it's crucial that you understand when you're getting yourself into this, or when you're in it for the very first time. I mean, what are some of the key things that one needs to understand, and what are some of these information, so to speak, that one would require to make sure that when they get into the process, then they have it all covered?
So I think one of the things that you realize when it comes to the residential tax, the MRI, is the requirement to keep updated rent books. So we're coming from a place where rent and rent as income has been very, very informal for many people, and the only thing you do is give your tenant a receipt, and that's it, and you get your money, spend it as you wish.
Yeah.
But remember, this tax is being charged on the gross, and therefore, for the commissioner's point of view, what matters most is whether they are able to estimate accurately what is the rate of occupancy in the house. And therefore, most of the times when you're doing reconciliation for rental tax, they'll want to see the rental records, and you must have a rent book which now says which houses are occupied, for how long, and so on and so forth. Then secondly, you also need to know that because of the synchrony of information between government agencies, it's also easy for the commissioner to evaluate the occupancy of every apartment, for example. Because remember, one, we have electricity bills. The electricity bills are linked to KPLC, and KPLC is able to tell the usage of electricity per house and how many meters are in that house. There's the water bills. You're also able to know in terms of water bills how that looks like. Then in some instances, the banks also are supposed to give the commissioner access when they want to verify how much has been paid or has been received by a landlord. So there are many ways to verify rental tax. But above all, and the information important for MRI is that for MRI, you do not have a responsibility to charge VAT. So therefore, this tax, when you pay it, it's final.
Okay.
And no one is going to come and ask for it much later.
All right.
Unlike the commercial tax, commercial rental income, that is not a final tax. Actually, it's not a final tax because you're paying VAT. But if, for example, where our offices are, if we were to pay VAT, we would pay VAT and withhold 6%. But then the landlord will have to, again, at the end of the year, come and declare his total annual rental income. And in that case, the difference is that he'll be allowed to deduct all expenses. These expenses will include things like repairs, things like electricity, things like, so all those things that that have been accrued to generate this income, he'll be allowed to deduct. So, but for the monthly rental income tax, the commission is not concerned with expenses, and those are the key differentiating factors. And someone needs to be very much aware in which regime they are in, because if you're in the wrong regime, you might end up paying way much more tax than you should be paying. There
are instances wherein you have both commercial and residential income. Well, for instance, if they share sort of a building or something of this sort, then what happens in such a scenario?
So in that case, you already have two streams of business from different taxable income. So what you're supposed to do is that you're supposed to separate the two. And you say for the commercial buildings, and that's very common in estates where the ground floor, you have shops, you have supermarkets, and they are doing commercial business, and therefore, for that particular stream of income, you cannot put it under the MRI regime because it's commercial rental. So it becomes income.
Commercial automatic.
Yes, so you now split your filings and say I have 10% of my filings are on commercial, the rest are on MRI. And therefore, when you're filing, you'll file differently. So for the shops, you'll not declare it on a monthly basis. And for the shops, you'll issue an ETR.
Okay.
But for the rest of the building, you're allowed to file it on a monthly basis. So that's a significant treatment, and it has been a big challenge for a lot of business owners.
Yeah.
And you find a lot of business owners end up lumping up all these expenses, all these taxes together. And there's a big disadvantage of doing that. You remember the threshold is 15 million. A lot of commercial rent is per square feet would be expensive than residential. So what will happen is you'll find yourself moving yourself away from the monthly rental income into the commercial. And you see, for residential houses, the expenses are very, very minimal.
Okay.
Because when is the last time a landlord comes to your house to say, we've decided to upgrade this house for you? Rarely. So you'll have very few expenses. So if you look at the calculation, 30% of your rental income minus few expenses is actually very, very steep compared to 10% of your gross without expenses, because the expenses for rental income are very, very negligible. So because of these variants, if your tax agents or auditors make a mistake and move you to the wrong regime, you'll end up losing a lot of money. And there are a lot of instances where taxpayers have been paying in the wrong regime, ending up parting with a lot of money that they've earned from their rental income.
If you do that, then is there a review? Is there something that you can do probably to reverse that scenario where you have remitted to the wrong?
So yes, so the law allows you to make an amendment.
Okay.
So long as the amendment is being made within 5 years from the date of filing. So the commission ordinarily for any tax allows you to make an amendment. But of course the requirement is that you should support while you're making this amendment. So when you've made this mistake, you can always go back and say you want to rectify the return so that you file it correctly. So unfortunately, in instances where it's beyond 5 years, many times it's hard for you to make that amendment. And sometimes that will be tax lost. Where there is an overpayment, for example, and you made an amendment, the commissioner can convert that into a credit, then you can offset it in the subsequent months.
Okay, well, when we talk this, and you mentioned so much so about the expenses, then what, of course, expenses are deducted for tax computation?
So if you look at how the Income Tax Act is drafted, they specifically say that they are allowing you to deduct expenses that are first incurred for the generation of income. And secondly, these expenses are supposed to be tied to the maintenance of the rental income that you have. And sometimes it's been argued, maintenance of the rental income, for instance, doesn't include reduction. So for instance, if someone decides to bring down one unit or to convert one unit into something that doesn't generate income, there has been an argument that if your expenses are incurred to reduce the income, then that expense will not be allowed, because the law says it's for the maintenance of the rental income. Now, the other qualification is that for purposes of determining what expenses will be allowed, then there must not be structural adjustments. So structural adjustment meaning it must not be, for example, a building that is not a construction that is beyond renovation. So for example, if someone decided to put up an extra floor here to increase rent, then that expense of increasing that rent will not be allowed as an expense, because it is not for the maintenance of the current income, and it's not a renovation of sorts. So the law does really curtail in terms of what you can deduct. And that's why I keep saying that the expenses allowed for rental income are very, very negligible. Then of course the others will be things like utilities like electricity, water, your management fees, if you have agents collecting for you, their commissions, and so on and so forth. So those expenses that are ordinarily incurred for the generation of income.
All right, looking at the basic of it all, and of late we've seen lots of chambers coming up, and as a group they decide that they're going to buy land, set up huge apartments for commercial purposes or for rental purposes, so to speak. When you have one, then more than one owner, or maybe shareholders in this particular entity, what happens?
That's a very clever question, and in fact, it's a very unique scenario. And of course, I know, and even take it further away. The current trend in the rental market is young people who are tech savvy are renting houses in Kilimani, in Hanningham, putting furniture in them, and listing them on Airbnb for the fact that they want to generate rental income from these houses on a monthly basis.
Yep.
So realize that in many cases, those units will be co-owned, so that I want to own it with you to reduce our exposure in terms of the risk of paying the monthly rent to the head landlord. So in instances where rental income is generated through partnership, so what you're supposed to do is that you're supposed to calculate the total rent collected.
Okay.
If you're paying MRI as a tax, then you're supposed to pay the gross. So you're supposed to calculate the total rent collected. If we own it 50-50, we divide it by 2.
Okay.
You get your money under your PIN. I get my money under my PIN. I file MRI under my PIN. You file MRI under your PIN.
Okay.
That is how it's supposed to be done. Because if it's a partnership, then the law does not acknowledge a partnership as an independent entity, and therefore a partnership cannot pay rental income to the commissioner.
Okay.
There's no provision for it. Right. So it must calculate, split to the owners, and the owners become responsible for filing.
Don't you think we might need to probably consider that in future, because then, well, this is becoming so common, and therefore then it would be more of a hula baloo to even imagine, because sometimes it's a family affair. But the other time we say that you can file under the name of your husband, and that's okay.
If you're a married woman.
If you're a married woman, yes, okay, all right, and vice versa.
Not vice
versa, no, not applicable.
No, it's only the woman who can file under the man's
wow.
PIN.
All right, that's pretty much unfortunate, but anyway. So how do I compute residential rental income tax from the partnership income that you speak about?
So because the residential rental income tax is a very straightforward tax, it doesn't allow you to do any deductions. Your only responsibility is to collect, compute in total, and say how much each person has earned, then split that into 2. Different from the commercial rental income. And the commercial rental income, you remember we are doing this at the end of the year. And therefore it requires a bit of accounting know-how. Maybe basic accounting know-how, but you need first say, total rent collected in the whole year is 10 million, for example.
Right.
I think in the next session, we are going to walk you through the chart of how to calculate it. But you say this is the total income less expenses. You subtract what we've discussed, your repairs, your utilities and all. Then after that you say net rental income realized is this much. Then now you levy 30% on that amount for you to get how much rental income should be paid. Now if it was a partnership, the partnership would go a step further at the end of the year and say net income realized is 5 million. 5 million divided by 2. If it's Linda and Eddie who own this apartment.
All right.
So 2.5 is owned by Linda, 2.5 million is owned by Eddie, and every person goes and files their tax returns independently. So the idea behind splitting it this way is because rental, and remember we say that personal identification numbers are supposed to create a personal obligation for tax. So the law is trying to say we want to know with whom to follow up with for this unpaid rental income. As a business owner, you now must make the choice when you're setting up the business. Is it easier for us to form a company so that we file our taxes using the company, for example? Or is it important for us to perhaps set up a different form of organization that can help us file taxes together? Now, for partnerships, there's a big advantage because when you file your income as partners, what the law says is that it's looking at the threshold of 288 to 15 million per individual. So that means we can remain within the monthly rental income regime for a longer period of time, because if you have 10 apartments, you split them into 2. That means you can actually survive without getting into the annual rental income regime. And therefore, partnerships have a serious advantage also. And then maybe it's the reason why many people want to be in them, because that way they guarantee that you're able to sustain. Others, if you are a company and your buildings are under 1 PIN, it simply means that if your threshold gets to 10 million, that notwithstanding that you have other new buildings, the entire real estate business must be filed under the annual rental income, which is a bit more steep. We just give them tips, to take advantage of the partnership angle. Anyway, that is in low tones. We do not want the commissioner hearing us say that. So scenarios, especially with the commercial aspect, where a client would decide to withhold 10% rent, and you're supposed to probably file this, after a certain period. Even I don't know how common that would be then in the residential angle. What then happens? So for residential income, you're unlikely, rarely will you find withholding tax being levied on residential income for obvious reasons, that the persons living in residential income houses are individuals, you and I, and the commissioner has not been appointing individuals as withholding tax agents for obvious reasons. That a withholding tax agent is vetted before they become an agent. Because an agent, it means you're collecting for the commissioner. So the commissioner would find it very hard to track down an individual, because an individual one is very hard to find because their address, their permanent abode can change anytime. But for the businesses, you'll find in a commercial regime, you will have withholding agents, and these withholding agents many times will withhold VAT. Then the withholding regime is an advanced tax, and at the end of the year, it is expected that you're going to come in at the end of the month for VAT. You're supposed to come back and declare how much extra income you have up and above what has been withheld. But the withholding taxes will be used to calculate backwards. So for residential income, we will not have withholding tax. Even for commercial income, you're unlikely. There is no provision to withhold rent. Because rent is not a professional fees as such. But for management fees, when you pay your management fees to your real estate agents, of course you can withhold. All
right, Idili, allow us to take a short break, and then we come back to expound some more on that. I know it can be quite a tongue twister, but all the same, it is helpful for you, and it's good that you're keen on this. We'll still be leaving this on our social media platforms, just so you can always come back and recap on the same as and when you might need that information. After this break, we come back with more.
Wondering what next in a crowded, confused and uncertain career market after KCSE? Worry no more. TV47, the fastest growing youth-targeted TV station across the 47 counties, brings you an entire month of career options and choice opportunities across all the leading universities and TVET institutions. We have put together a rich group of experts who will guide you through your career aspirations throughout the month of May. This will climax with a virtual career fair scheduled for the 28th of May at the University of Nairobi Auditorium. All relevant stakeholders are invited to reserve a seat via david.katiku@tv47.co.ke or careersfair@tv47.co.ke on 0791 999 883.
New Blue Band peanut butter. Made with 100% pure peanuts and a good source of omega-6. Grow healthy and happy kids with New Blue Band peanut butter.
Hey, now that's hitting the right notes. When life gets boring, we bring out our play. You see, playfulness is in our DNA. It's in the way we move and laugh. It's in the way we walk, the way we rock, and how we just don't stop. You feel me? We add color to everything, to every day and every dish, because the world needs our crazy. We're the different flavors that make life more exciting. We're the ones who add color to every moment. Fanta, color every moment.
Raukia siku njema na tunukiwa offers kila siku. Pata offers zote mahali pamoja ili uongeze zaidi, utume SMS zaidi na ubrowse zaidi.
Usijali, Tuma namba ya kila supplier kwa hiyo soko. Ndio nitaongea na kila mmoja wao.
Very good. Piga *444 utunukiwe Credo double.
Raukia siku njema na tunukiwa ofa.
Rental income, and with me is Edwin Thiongo, who's a tax lawyer. We also are expecting to get a hold of Geoffrey, who will be taking us the process of filing these returns, which is pretty much important. And before we get to that, we still are pondering some more and getting to understand more in regards to these processes, what is involved, what is there, who's eligible to the same, and how best then you go about it. And so make sure that you keep it right here. Still open with the lines, #Morning Cafe at Linda_Lela TV47 KE. We get to sample some of these comments as we get to proceed. And just a recap, because I know you've mentioned this, but then again, it comes in as a question, and therefore if someone has sent the question, we have no choice but to just somehow take them through the same and say, the question is, when do I pay the monthly rental income tax?
Okay, so the monthly rental income tax, as I mentioned, should be distinguished, payment should be distinguished from filing. So the filing obligation is on a monthly basis. Every month you must file. By the 20th you must file your rental income tax. But for payment, you can pay it on a monthly basis, a quarterly basis, or half yearly. So the confusion is that people assume that payment must be done on a monthly basis, but there is room for you to opt when to make the payment, but within the cycles that I've mentioned. So so if you're calculating your monthly rental income, it's prudent for you to compute and determine early enough when you're going to file it, but when you're going to pay it, but filing your tax agents should be able to advise you. You should be paid on a monthly basis.
All right, lots of misconceptions, as many would put it, in regards to the sizes, location, construction, materials used in the building, the age of the building, of property, like what it is that you've said. If you're setting up another one on top, it's a whole different affair in comparison to this. So how then do we get to the aspect of counting and also the computing of taxes for residential rental income, in relation to these ones?
So you realize that because MRI is a monthly tax and it's final. So ordinarily, the law doesn't allow you and will not allow you to claim capital expenditure. And capital expenditure is the cost of putting up the building. For example, you say the cost of putting up the building by itself is a capital expense. The cost of reinforcing the building, the cost of expanding the business is a capital expense that you're not allowed to deduct. But when you calculate rental income on a monthly basis, the assumption is that you're being taxed at a lower rate, meaning that lower rate then indeed means you have been given some sort of leeway. They've been taxed at 20% and not 30%, and therefore for capital expenses, you will have to amortize that over time. Now, if you're an individual who is filing taxes, or even a company filing taxes, the law has created specific requirement when you're filing your annual taxes. The columns that we were seeing last time, there's a specific column for rental income. So rental income, we call them section 15.7 taxes. They're called specified sources taxes, that they are not allowed to be mixed. So I had a scenario where somebody was trying to claim expenses incurred in putting up the building against expenses incurred in his normal business against his rental income. Now, of course, if you do that, it will be disallowed because the law is saying rental income is separate from any other income, so you cannot mix them. So previously, people would file all the expenses together, then even if I made a profit in rental income, it is taken in by the losses I've made in other businesses. So that separation is important to make sure the commission doesn't lose.
Okay. All right. One thing that will be key then is understanding the penalties and what happens if I probably file late or if I fail to actually remit this. And generally how much information is out here, because then the introduction of this tax is so recent, so to speak, not as recent anyway, because then we're talking of 5 years or so. And so in the event that probably someone has been operating in the dark all this while, and then this was introduced, just how much information went round so that these landlords can get to understand, and how then does the commissioner get to these people?
So the commissioner has actively tried to bring in a lot of taxpayers into the tax bracket by, for example, the voluntary disclosure program that they were running, I think early this year and towards the end of last year and early this year. And that program is meant to say that if you come and declare taxes you've not been filing, whether or not they are 5 years or 6 years old, the commissioner is going to give you a waiver on the penalties and interest. So people should have taken advantage of that and just file if you are not filing properly. So that declaration is to keep you away from penalties. So penalties for taxes are extremely punitive because remember they've been harmonized now into one tax, which is called the Tax Procedures Act, which dictates how penalties will be paid. Apart from specific examples like rental income tax, where they have their own specific tax for non-filing, which is I think 10,000. But for the other taxes, you'll find that the penalty comes together with an interest. And the interest is at a rate of, for example, of 1% per month, or I think it's 1% or it's 1% per month, or 25,000. But for other taxes, you'll find that they're going to charge you for monthly rental income. The penalties will be calculated on a monthly basis for non-filing. There's also penalties for non-payment. So the two penalties will be calculated as though they're independent of each other. So if you are deliberately failing to pay your taxes, there's a penalty called a shortfall penalty, which is a punitive penalty for failing to file it in good time. So if you consider all these complications that come with non-filing, I think many times it's easier for you to comply because you do not know when the next voluntary disclosure program will be available for you to file your taxes. Then of course above that, under the Tax Procedures Act, you can also get prosecuted on a personal basis for tax evasion.
And now that we've seen the adjustments now working into 2021 and the review of the numbers or the monies that we're talking about a little bit higher, just how expensive is it or how more expensive is it for the commercial aspect in comparison to the MRI?
So I always say that, you see, the commercial aspect of rental income has more expenses, or you'd expect there to be a bit more expenses because one, the utilities are high. So if you compare how much you're spending on electricity and how much someone in a business would spend on electricity, there's a huge variance.
So the rate is standard though?
No, the rate will be different. So for residential income, you remember we are saying it's 10% without expenses.
Right.
And therefore 10% of the gross could actually be lower than 30% of the net, because the expenses on rental income are very minimal. So for commercial taxes, I think the biggest catastrophe is someone who is on residential tax regime, who is paying taxes under the annual tax regime, the commercial tax regime, because that regime is expensive for them. So give an example: if a landlord has a house and you're renting, total rent collected says 300,000. 300,000, if you have to subtract the total expenses, you're going to factor in your water, your electricity, your management fees if you have any, and any repairs or renovations you've done. Assuming that cost come, best case scenario, say 50,000. So you still have 250,000. So if you say 250,000 and tax that as 30%, would actually have a very slight difference from taxing 10% of the 250,000. Of the 250, And that's of the 300. And you see, the problem with this regime is that the space for expanding expenses is very limited. So the biggest problem is that when you have landlords who have not taken advantage of this monthly MRI regime, they are still being advised by the auditors or tax agents to file at the end of the year. Then they are significantly losing money, because if you take 30% of 250, and that's an apartment, it's a reasonable amount for an apartment, it will be extremely high. So the challenges are trying to understand where you are and working through the expenses, so that you realize that if you're within the bracket, please be within the bracket. If you're not within the bracket, find a way of being in the bracket if there's a way to be in the bracket legally.
And that's what we're huge on. We are here to just tell you that, you know what, we're enlightening you so that you take advantage of this, taking advantage in a positive way, making sure that you file your returns, make sure that you pay to avoid these late penalties. The little knowledge that I've gathered is that when you I have filed late, then you attract a penalty of about 2,000 bob or 5% of the tax due, whichever is higher for individuals, 20,000 or 5% of the tax due, whichever is higher for corporates. And of course, penalty on a late payment is about 5% of the tax due, interest of 1% per month on the unpaid tax until the tax is paid full. I don't know whether you have well articulated this or unpacked the same for us. You probably would wish for you to tell us that more on that.
No, I think you've said it spot on.
Okay. Yes, and that's why I keep saying by the time I'm done with this, I'll be a tax expert.
No, you've said it spot on.
Okay.
So the penalties and interest are properly defined under the Tax Procedures Act, and for rental income, you'll find the same definition of taxes within the Income Tax Act. Maybe without going back to how they're classified, is maybe just to mention how these are calculated. So the problem with tax is that interest accrues continuously on a monthly basis on the principal. So if your principal tax was 50,000, they're going to charge interest on the 50,000 until you pay it. So there's a rule that says that the interest on tax cannot exceed the principal. So it gets to a place and it fluctuates and stagnates. You cannot go beyond that because legally that is not possible. Okay. Unfortunately, the Commission has not been doing that. And unfortunately also, iTax doesn't do that. Okay. So you'll find in instances where the penalty, the interest has been calculated way much higher than the principal. And in many cases, when you have such cases, we have been engaging the Commission to say the law does not allow this. You cannot, even in the bank, for example, your interest cannot exceed the principal. But the penalties accrue based on time, and they do not give regard for the principal. So if you take 10 years to pay, every month there's a late payment penalty that is being levied. So the law then says that when it comes to what you call waiver, so the Commissioner can give you waiver for interest, but penalties can only be adjusted. It's called remission by the Cabinet Secretary. So again, it's also very hard for you to get remission. If you get remission, you must explain where were you all this time. So sometimes it is those things that people are not aware of, and we take it lightly that we should be paying taxes in good time. But when you're the one, your foot is on the plate, you realize it's actually very, very difficult. So I know a lot of people who maybe could be watching who've not paid their taxes, who are late, but it is better off for you to start early enough. File your taxes, request for waiver of interest. Then, once you've paid the principal, it's easy for you to start negotiating on the penalties that are remaining. Okay. Yeah. All
right. And there are times that, especially at this point of COVID-19, lots of adjustments have been made. And so, for instance, maybe you had entities for commercial purposes, and then we're talking about these caps in terms of monies, that are set, the 15 million, the 200 and something million, so to speak. So people have had to adjust maybe their rent fee downwards. With such adjustments, what happens? Because then you probably leave this capping of the commercial bit, and you come to this, you step a bit lower. These adjustments, what happens?
So then when it comes to the two regimes, being in the first one, for example, is a requirement, but the Commission allows you to make an adjustment in terms of the regime you want to move into. So in instances where companies, for example, and it's a good point, that during COVID and during these difficult times, a lot of landlords have been unable to reach the threshold required for them to remain outside the MRI regime. So what has been happening, or what is likely to happen if you have in such a case, is that you can make an application. If you forecast and say that the rental income you're going to collect isn't going to be outside the cap for MRI, then you can apply to within the cap for MRI. So there are also instances where you have, because MRI is based on gross collections, so you can have tenants in your premises but are not paying. And a lot of our clients who during COVID opted not to collect rent for some period of time to allow the families reprieve. So in such instances then, if they're within the threshold, then they can actually apply to be within this threshold. But then of course the consideration is you must be able to project that you will not go outside the threshold, because now the moving in and out of the regime can also create significant complications in terms of how you actually file your final returns. But it's elective, and the commissioner considers whether the case is merited or not. Yeah.
All right. Well, and what's key at this point then is for us to understand just how then does one go through this procedure of filing. I think we already mentioned some of the key things that you would need ready. You need to prepare the documentation that you need to prepare at that point when you are getting into it. First timers, how then are they welcomed into the system?
Okay, so for MRI is a bit more simplified than you would when you're filing your annual rental income. So the annual rental income tax, the filing process is as what we explained the last time. You will have to log into iTax, you will download the Excel, you will fill out the expenses column, what you've incurred. Then eventually it's going to auto-calculate and tell you how much the tax is paid, how much you're going to pay. For rental income, I think it's far much more simplified, because once you log in, all you're required to do is declare how much you have earned. Then automatically it's going to calculate 10% of that, and then you pay, generate the PRN and pay. So the monthly rental income is a bit more straightforward than the commercial. And you remember we said that the commercial is complicated because of the various levels of expenses allowed. And how to calculate, to bring them to book, it will be a different process. So I think maybe when we have the next on Tuesday, we can begin with a recap of how to exactly do the filing, and the audience can be able to see how exactly the calculation is done. But if you log into iTax, it's more or less a step-by-step process that you're able to understand. And by the way, when you log in, it asks you which tax you want to file. If you say you want to file residential tax income, then the rest of the process are very, very straightforward. And of course, you can get assistance if someone is an e-stack. Yeah.
All right, and yes, we were expecting to have Geoffrey in my area so that he would take us through the process of filing, but all the same, not a problem, like you rightfully put it. Maybe the next round, then we kickstart from that. Is there a scenario where we can paint a picture for someone who's probably in need right now of what is likely to happen, or then what do we carry home, as a call to action, as parting shots, as something that probably would be necessary when we talk matters filing returns, or maybe generally looking at the taxes in rental income tax?
So for rental income tax, and I say this because rental income tax is a very, very popular tax in Kenya, especially considering that in Africa, land ownership is a serious issue, and there is no country in Africa that doesn't consider land a serious economic factor. But then it can become slavery for a lot of families because of taxes. And I'm saying this with reference to people who are up country, people who are in places where they have small rental units, and they need to understand exactly how these taxes work, because whether you are aware or not, if you have an obligation to file and you've not filed, penalties are accruing. And I think we'll get to a place where, because most children will inherit real estate, at least in the next 2 or 3 generations, before we get to a place where you're a bit more sophisticated. Then if you're working to build an empire that is based on real estate, then you must be very careful that by the time you're handing it over to the next generation, you do not hand over taxes. And I give you an important principle in tax. If an asset is owned by someone who owes money to the commissioner, any transfer of that asset to the subsequent person is deemed to have transferred that liability. And that provision is there to ensure that before transfers are done, the commissioner is paid. So how many people in this country own real estate blocks, own huge properties, but are not paying taxes as they should, and yet they expect their children will come inherit? We might actually be working towards a generation that will inherit serious debt. So it's better to be prepared, do it now, rather than wait for when it's too late, the penalties are unpayable, and then the property is lost.
And I'm curious, when we're speaking about this, then we're talking about, say, units. Maybe there's this one block unit, and why it's huge, that really reaches or meets the threshold that is expected for an individual to pay tax, or the owner to pay tax. So when we're talking about an individual, do we conglomerate all the, all the units that they have, so that then we say they fall under this bracket, or maybe it's unit by unit by unit?
So it's the total rental income
across.
So remember,
it doesn't matter. Yes,
across. So
yeah.
so what has happened over the past? So the regime of apartment ownership has changed over time. So you find that it's possible for you to have one unit, but every unit is an independent unit by itself.
Okay.
What you call the leasehold ownership model. Then you have sectional ownership, which is currently what we are trying to push for, so that if you buy an apartment, you get a title. So for rental income is identifiable units. So they can be identified by their own pins.
Okay.
Then they can be filed
separately.
So strategically, some landlords have opted to split the residential units into more than 1, 2, 3 blocks to just manage the filing of rental income tax. It has an advantage, and it's strategically sound, and it's within the law. But then again, if the whole building is under one pin, then you have to declare it under the other annual tax regime.
And so if you have other buildings, different areas, because then we've seen landlords, you know, with this unit here, a different one somewhere in Umoja, a different one somewhere, you know.
So again, it's the same principle.
It's the same principle, yeah.
If you have 5 buildings,
and they are all under one pin.
Purposes, they're under one pin.
Then
we'll say your total rental income is the total rent collected from these 5 buildings. So I think strategically someone needs to make sense and say, doing this, what does it mean for us? Do we save more or do we lose more? And try make adjustments that can assist you, you know, in terms of filing your taxes. So from a legal standpoint, nothing prevents buildings owned by the same person being put under different companies. It's common knowledge that people do that for strategic purposes and of course for purposes of intercompany borrowing. So you can actually do that. And I don't know if it's knowledge available, but many times I find that people just file for the sake of filing without thinking whether this is the most efficient way of doing it.
Well, thank you so much, Edwin Thiongo, tax lawyer. Unless there's anything else that you'd want us to add on to this, I guess it's fair to leave it at that, as we keep encouraging you to, you know, just have a recap of the same, because these are things that you actually need to go and recap on. And so the platform is open, #Morning Cafe. Well, you get the link there, and you know, the lines are open on social media platforms, and those ones of KCK too. You can always get this link and get to understand some more on taxation of rental income and numerous other taxes that we've touched on so far, as we look forward to a different conversation altogether next week. But then remember, we start off from that point where we'll take you through the process of filing these returns or just meeting the same, right? Thank you so much, Edwin. We close it at that.